Well, hello everybody and welcome to another live event here. We're talking about the ASX Open today. And of course, the ASX 200 is getting melted here, Tyrone, ahead of the Open, or as we open up. And that's because, of course, the US entered a technical bear market last night. And it's pretty brutal, isn't it, out there?
Yeah, it is. It's a very, very brutal market. I'm not surprised that we saw the Aussie market weak. I didn't think we're going to be seeing a potential 65 on the handle at some point today, which is very, very likely given the futures are only about 10 away.
So
yeah.
Yeah, it's pretty bad. Yeah, so we're down about 13.73. So obviously, ASX 200 been holding up a lot better than other markets, and the main reason why is, of course, the inflation components that we have. Just remember, everyone that's joining us today, the big thing that's in the ASX market is we have three main sectors. We've got finance, we've got energy, and then, of course, we have metals. Now, because we have those three main sectors, similar to the FTSE, if you have a lot of inflation around and inflation is continuing to rise and rise and rise, we traditionally do pretty well during those times. Just go back and look at history and you can see what happened during 2000 to 2006. So what this tells us, Ty, is that this is more of a broader market sell-off now based on not only just the inflation concerns, but it's also now growth concerns. It's also now real earnings concerns across the board. So there's so much going on in these markets now, isn't there?
There is. And now, look, there are bigger things at play now than just inflation. Inflation is just one measure. Realistically, you know, we could be seeing the potential turn of a business cycle wheel, and inflation does start that. So, and I think that's where the concerns are, that it may not be that that the growth is a concern, you know, generally as part of a bigger picture, not just inflation. It's obvious that, you know, inflation, interest rates going up, you know, money, you know, getting you less than it did yesterday is going to be a problem for growth eventually. But yeah, there are bigger things at play than just that. And yes, it is a driver. But yeah, guess what? We've known that there's an inflation problem for the last 4 or 5 months. We've been talking about it. It's been a fear. So it's not about inflation the last week, is it? No. We've known about it. There are bigger concerns than that now.
Well, I think this is a worldwide slowdown, and obviously the problem is that slowdown comes, and I've always said this, that the main issue here is obviously the supply side, and that comes down to the policies that are set out in China at the moment. I think if we manage to see that turnaround and you see either a vaccine that gets rolled out that they're happy with, or some kind of reversal of COVID policy they tie, my firm belief is that markets will like to rally off that. And I think that's the big information. You can see it in the results right now. It's a big area. So where do we hit this morning, and what are we seeing here? So we're obviously seeing a bit of a melt off of this market. We'll talk about the stocks as they open up. As anyone knows, when you're trading ASX, obviously stocks open in segments. So we'll see the full story very soon. And then we'll see the options market open after that. But US 500, we noticed that it's forming a little bit of, I wouldn't say support, but certainly basing around this 37.59. Now, we'll go back over to that in a second because it is important for today's ASX discussion. But notice here, we're in an area where there's been quite a lot of demand. During that previous spike that we saw that came through in the beginning of the end of 2020 into 21, Ty, the market found a base, and that base sat around that 65.50 into 66 zone, which is exactly where we are right now. So has it made the move down that we expected? This is now how many down days? We've got 1 down day, 2 down day, 3 down day, 4, 5. That's 5 big reds. That's unusual, isn't it? In terms of not having at least one relief.
It is. Only it's very, very rare that happens, especially in the magnitude that we've seen it happen too. It hasn't been. I mean, this has been a fall from, you know, effectively nearly 7,300. We're talking about 700 points, so it's a pretty decent fall. And it looks like it's only a matter of time. Actually, I just saw on the futures market, I did see a 65.99 right there. So yeah. Right now. Yeah, so it's really, you know, you look at it like that and you say to yourself, well, do you really want to catch it? I mean, that box that you've drawn right there is the only real level of support that we can actually see, if there is going to be any. And that, you know, the next, unfortunately, the next level is actually hundreds and hundreds of points away from that, which is the next real level is about 6,200. And
yeah,
and boy, oh boy, we don't want that. We don't want to be seeing it down there looking for that critical support. I think that is critical support there. That level there is extraordinarily strong, far stronger, by the way, than what we'd be seeing here at 6,500. That level is serious. So, hopefully we don't see it go down, down there that quickly, because like I've said along the last few weeks, markets that are melting down are very difficult to trade, because you don't want to get involved in the short, because the rebound can be very severe and aggressive. Support isn't always what it's cracked up to be, especially when it's falling and melting down. So it's not a market that's easy to actually intraday trade. It's a market that you can actually pick up value for from an investment standpoint. Yeah, there's no question about that, but it's difficult to trade, and trading is what we're all about here, right? So ideally, in a perfect world, we need a few days of stability is probably a good start. Find a level and actually not so much rebound. I don't think we need to see a rebound of 400 points to actually say, oh my God, we're safe now. I think I would probably rather see a week or two of actually consolidation and see let the market actually find its feet, because now we're getting to the levels where we're probably not really at fair value anymore. We're probably below fair value, because the economy, as much as it's got headwinds, it's not exactly dead either, right? Like, we're in a pretty good place. So there's no need for our market, short of something that we can't see, being in the low 6,000s again. So even at 6,500, you'd have to argue it's pretty cheap, Tom.
Yeah, I think if you approach it from a longer term standpoint, you could make arguments that Australia is well poised in the current decade moving forward. A mixture of those three sectors we talked about, a mixture of everyone wanting to go green in terms of governments around the world. They have to burn a lot of oil to get to that point. And of course, the geopolitical risks of buying metals in other countries versus us. I think we are poised. We're lucky again in this aspect, Ty, and it's what we've argued really in terms of relative performance improvement for something like the UK and ASX, and it's why we've been pretty much sitting on these kind of sectors or these markets. But this is a very interesting point. As Tyrone mentioned, if the market's just basically sledgehammering into this area, but I did want to bring up the SPY, because as you know, the US market and the Australian market do hit levels. And I've got two zones here in the SPY. I've got this current one, which is the 37 kind of 50. And I've got the one underneath that, which is the wicks or the demand zones previously. I know we're talking about ASX. We'll get into the stocks as they open. We're just about to see them all go through. So, yeah, I mean, basically these areas here are very pivotal zones. Now, the market, everyone will be bearish today. Everyone. And Ty, one thing I say is that when everyone is bearish, that's when you often look for the opportunity to potentially return. Because we've now had 1, 2, 3, 4 days down in the US. We've left two gaps that are here and here in the real market. And this becomes a statistic. And the statistic I shared in the previous video, 4 consecutive 1% daily declines. Very rare, only happened a few times over here in past history. And in almost everyone except for these two here, you've seen it be not so much necessarily going to be the bottom. I mean, obviously it was the bottom in many of these cases, but what it really showed you is that it was a fearful capitulation style sell-off that was met by demand. And that demand ended up coming through pretty much very few days later. So it was coming through very, very quickly. And that's because too many sell-off days. We know markets can't stay fearful for too long and run away from their mean reversion. So we'll chuck on the ASX 200. We'll put the 20 on it now. But do you want to talk us about this idea? What do you think?
Yeah, I will. The other thing I will probably just preface what we're saying today is that we had a very unique, it's unique and probably unfortunate all at the same time. We had a public holiday yesterday, and the ASX market in its actual, live market was actually closed. Right, so we saw a massive sell-off in the US on Friday night that we didn't get, even though the futures acted, the actual real market didn't. You can't sell stock over the weekend, right? But also, as a bit of a perfect storm situation, we couldn't actually sell stock on Monday either, because the ASX was actually closed. So what that meant was for the retail trader who is actually margined up, margin calls wouldn't have kicked in as early as they normally would have. And consequently, we've seen two massive gapping candles. So we're a lot lower And this is always the risk with margin calls. If in an event, in a perfect storm event like that, where you're actually closed for 2 days and the rest of the world is selling off like a demon, you're actually going to be in margin call quicker than you think for people who are actually heavily leveraged. So that may play out over the next day and a little bit as well. We just want to be really mindful of that there could be a collection of margin calls. And when margin calls kick in, if people haven't got the funds to actually top up their account, they get automatically sold. And what that does, it puts downward pressure on the market immediately, because brokers are just selling off those positions to make the margin back to a square level. Okay, so just be very careful with that. Trying to pick a bottom on the ASX 200 might be just fraught with a little bit of danger until we've got a couple of days of opening and everything just kind of settles down. I just want to just mention that, because we very rarely talk about it, but we very rarely have a public holiday where we see a 10% drop. So it's something we just need to keep in mind.
Yeah, so we'll load the extra one in a second. So 7% down, of course, in the ASX was last time away from the 20. And at this point, we are also around that point. So as Tyron said, there's going to be a little bit of fear selling because, of course, margin's usually between that 11 and 12 area. So we'll find out what happens there. But 7.5 was last time. So it is getting fairly far away from its 20. We've seen it further, obviously, when it was just getting obliterated during this time. But yeah, it's an interesting point. Well, let's go over to some of the market and just update this type. And basically, this is the sectors. Now, this is Tiger Brokers. As you can see, they're sponsoring today's video. So if you're interested, especially if you're Australian, consider opening an account with them. They've got a special offer, Ty, which is pretty damn good. You open an account, $3,000, and you'll get I believe, a free Apple stock, and I think a free GoPro stock and a free little spin of the wheel, which you can win like a Tesla stock. It's pretty cool. Good platform for ASX as well, because you manage to get heat maps, which is awesome. I love heat maps, and Tyron and I love rotation. So as you can see, there's only one sector that's opened up here that's any good, isn't there, in terms of the markets today?
Yeah, it's probably the one that you would probably expect, because as for the rest of them, it is just a sea of red. And what I love about the heat maps as well is that the different layers of red give you a very, very quick. You don't have to spend an hour analyzing a heat map. You can see very, very quickly. If you were, say, comparing your portfolio towards, you could make a very quick comparison to the sectors that you're heavily based. And as you can see, I mean, today is a very difficult one to look at and say, oh, wow, it's a bit of an even mix. Obviously, everything is just getting absolutely smashed, as we would have expected. I'm probably surprised that there is even a green. Actually, I thought it was only going to be a red. Did you expect the green, Tom?
Well, I think this is coming out of the, in terms of the markets. I didn't really expect too much green stuff. I think it's mostly just a red fest, but steel in particular, just horrible, Ty. I'm looking here at some of the numbers. We'll check out BHP in a few seconds, but yeah, didn't expect too much in the green side of things. No.
Yeah, and steel. I mean, it's one of the minute there's growth concerns. What's going to get hit? You're going to have steel straight away. The thing that's actually, steel and iron ore, obviously been driving this extraordinary growth, especially for Australia. When there's growth concerns, even if don't make no mistake, there hasn't been an order dropped yet. This is all speculation, right? Like, it's not like, companies are canceling their orders everywhere. And and that's why we've got to be a little bit careful. The market's reacting like, half the orders of steel for the next 6 months have been cancelled. That's not going to be the case. But the fear of that downturn, now, does that warrant the crazy percentage sell-offs that we're seeing? Well, maybe if it was overinflated, and maybe if that price was actually factored in, that we were never going to see a pullback. Maybe that's why we're seeing this. But I'm always mindful, and maybe it's a glass half full approach, that we haven't seen cancelled orders yet. This is just pure fear. Fear is driving this market.
Yeah, so ASX coming into that zone. Let's have a look now at some of the stocks. So we'll load up BHP, as we saw a lot of companies weakening here. And I'm not too sure whether this is actually live. Is this live? I've got BHP. 1 second. Let me just check my BHP. Yeah, it's not. This is not live for some reason. I have to check that with TradeUP. So we'll go back over the Tiger and we'll load up BHP here. So basically, BHP is down about 6.5%, Ty, 43.18. Obviously, we do have a few platforms here open, and it's pretty far down. So if we look at it from where it's been previously, it's back into a fairly heavy previous demanded zone. If you consider what's happened with BHP recently, we loved it back here in November of last year. We obviously loved the inflation game. A lot of people are, sounding the alarm on these stocks, but I think BHP is fairly well diversified still. It's got a couple of other. I think it's got a decent business in fertilizers as well, which could continue to do okay over the next couple of years. So it's back on a level here, Ty. Do you want to pick this level up? Do you want to more just kind of consider the price action today? What are you looking for generally on these charts?
I'm looking for price consolidation. This is not the time to be throwing it out there saying I think this is the bottom, because the truth is we don't know. I don't think anybody knows until we see stability. It's one of those ones where, again, it's markets like these, Tom, that I think you have to decide: are you an investor, are you a trader, or are you both? And absolutely look at it from a very, very different lens. Because if you are an investor, you're going to look at levels here and say these are bargain levels. Even if the market goes lower, you're still getting what is on average a very good buy at a particular price, and you're not going to be too sad. You're not going to be wrapped. But if it does fall further, you're not going to be sitting there saying, "Oh wow, what a terrible mistake I've made." Because in the longer term, we're very confident these are obviously at a historically good levels to buy. But if you're a trader and you're looking at getting in and out in a week or two or in a couple of days, I think these markets are fraught with danger, especially when we've seen again on our market, we've seen a close for a very, very important day when we would have been down a couple of hundred points. Instead, we're down 400 points. And then quite often that sets alarm bells ringing even louder. Okay, so it can make it. Well, it's not easy to trade very, very, very volatile markets. I know people always want volatility, but it's very difficult to scalp them because the rebounds can be extraordinarily aggressive. It's difficult to time your stop losses because rebounds can be extraordinarily aggressive, and continued sell-offs can actually be sharper than you think as well. So, to me, it's a bit of a watch and see market for scalping right now. If you were asking me this morning which trade I'd want to be putting on, but as an investor, I think that there are opportunities already.
Let's take a look at BSL as well, Ty. Blue Scope, we'll load up that. Obviously, I think this chart's going to be slightly out here just for a second, but what I wanted to just show was, Blue Scope, I'll give you the price. So it's trading currently today at 1608. Just load up the right BSL. Okay. At 1608, so there it is, 1625. He's slightly delayed, but 1608 at this stage, and it's coming into again a little area. So this again brings up your point of there's a difference in markets. Tyron and I'm going to say this right now, and I think this is the biggest bit of information that can help you when you're trading. I say this to mentors, and I think it's a huge component. And if you're here and you're lucky enough to get it, then that's good. If the VIX is above 20, greater than 20, you've got to pull your pairs in. I'm sorry, that's just the way it is. You've got to pull your pairs in. You need to understand that this is not VIX above 20 means fear. Fear means don't go and try to be a hero on specific stocks. Instead, you come back to the markets such as the indices, such as the currencies, such as the metals, those types of things, and you stick to those for the time being. As the VIX creeps up and becomes greater than 25, you've got to pull in even more. If you understand sectors, you can still get involved in them in this area. But at this point, you have to then just say, I'm not trading these stocks. Why? Because, Ty, the market doesn't care about this level, does it? As in, this real stock market during fear doesn't care about your supply demand, doesn't care about your support resistance. BSL is here. Does it really care about this level? You might say, okay, that's a great level for me to dollar cost average or whatever else concept you approach the market as. But I'm telling you, if the market wants to go lower, it's not going to just support this zone. So looking for supports and resistances on specific stocks during this time, I think it's fraught with danger. And we've been through a few of these now.
Yeah, most definitely. Yeah, most definitely. And look, and Anthony, to answer your question, Anthony's got a question there. How would we look at like potentially buying up the XJO? You're 100% right. I mean, you have answered it correctly, Anthony. We would be looking for structure. We would be looking for the smaller time frames to start actually forming the lightning bolts that we want, and then we look for the breakup. Because guess what? That price action that you've just described there is actually a market consolidating and giving the market a chance to breathe and actually respect an area. Trying to pick that area prior to it happening is fraught with all sorts of danger in markets that are basically liquefied. They're falling so quickly, like there's just no catching them. And
Yeah.
And you would be guessing. And look, we've never been, not in the last 10 years anyway, people who are going to go in there and guess what the market may or may not do. We go on facts. Tom said even in last night's stream, he was talking about you want to be reactive and not try and actually predict, because prediction is a very none of us are Nostradamus here. It could be a very, very dangerous game. So, but taking the other approach and saying, all right. Yeah, and look, make no mistake. Thomas and I have got for our clients countless millions and millions of dollars in the market right now. But do either of us sound panicked? Absolutely not. And why that? Why is that? It's because we've got risk parameters in place to actually take care of that. We've got options in place to take care of that. And panic is the worst thing that you can do. Panic is what 90% of the market's doing. Right. And that's what you want to avoid doing at all costs. You really want to be reactive, not predictive, like Thomas said, and really just let the market settle down. The market will settle down at some point, but it's not going to, we're not going to try and preempt that. We're going to let the market do its thing, and then we will be able to work with it. But I've said many times over the last few weeks that a market that is free falling is a very difficult market to trade, because the rebound can be just as aggressive. And you'll remember, most of you will remember last week I said that if you take away the symbol of the US 500 and the ASX 200, go on a weekly chart, and all we see is a series of lower highs and lower lows, we were not out of this downtrend. No one should be really surprised by this, because we never actually changed from being in a downtrend at those highs. Never. And all this is a consequence of it deciding that it's actually going to keep going. Now, yes, there are many, many factors that are making it do that, but it's not like we were in an uptrend and all of a sudden we're seeing a crash, right? Like we've been down for a fair bit. It didn't just happen last week.
Yeah, so I think a lot of people say, well, when is the best time to go long? When react, don't predict, is what I say always. But look, Ty, look at the history. Let's go back over history. So plenty of times there's been rallies. The question is it the real rally? When rallies tend to come in, they often do fall back to new lows, and generally you'll get like a secondary dip off these pools. Like when a market goes up, it comes back to get it. When a market goes up, it comes back to get it. And this is something that catches out most beginner traders. They don't understand that markets will often sweep the lows, which is even something that's possibly happening here in the SPY right now. It could be sweeping out the lows. I mean, imagine the newspapers, bear market, bear market, bear market. You don't think I'm going to put that on our video later? Of course, because this is a technical bear market. But I've seen a few of these, and when they tend to occur, what often happens, Ty, is it doesn't go much further and then it has a bounce. That doesn't mean it doesn't come back later. But these sweeps underneath, whenever you're thinking about markets and how they come back, if you think you miss it, you don't usually miss it, because even if that's the low, it comes back and gets you an entry. It's just, can you spot the change? So here it made a new peak. It then came back down. That new peak changed the trend back to up. Exactly. It was still up. And this became very investable or very purchasable. All of a sudden, there's even structure in here. This is a daily. So the market does come back and give you the opportunity. And that's almost every time. Here, it does. Here.
And probably the even more important part of that, Tom, is, yes, you're right, 1,000,000% right, that it gave you many opportunities to get in. But even if you missed any of those opportunities, when it did eventually break out and go, it came out and tested the 20 moving average no less than 1 million times on the way to its all-time highs. So even if you missed that initial break and you waited for the patience and you waited for everything to start moving, you had another 1,000,000 opportunities to enter anyway. Now, are you going to be that sad if you entered? Maybe you entered a bit late, but you know what? You're still making good money because the market's going up and up and up and up, which it did. And probably my point there is not to want to be the first person in there going long, because you don't need to be. Because when a market actually does get steaming and moving along, even if you miss the first break or you miss that little component that Tom was talking about there, you are going to get another 1,000,000 opportunities to get in. And it may not be the lowest point, but does it have to be? And I think that's probably the point. It doesn't always have to be the lowest point, as long as it's at a good point, on a point where you're not jumping on a runaway train that's already at top speed. In other words, buying it at a peak. You're buying at a trough, and that's what investing and trading is. Trading with what the market is telling you, and just placing your positions accordingly. You don't have to be the first soldier.
Yeah. Abundance mindset as well, Tyrone. Like, I think I know where all of this comes from. And obviously fear of missing out, FOMO, is a big thing. But we've got to think about 2019, 2020, and 2021. We saw Bitcoin rise from 5,000 all the way up to 60,000. We saw hyper stocks go from $20 to $600. We saw the rise of you have to buy on that day, and then it would go up 100% over that day. And if you didn't, then it wouldn't be there. Trading is not that. You will get destroyed with that mindset. And it's why so many people getting destroyed right now, unfortunately. They're trying to pick the dip. They've still got that buy the dip mentality. Buying the dip is not wrong, but buying the dip with information is much better. So once you have information and you can see, like, say, buying the dip here when it flicks it and it goes back up, or buying the dip on these little days here once it comes back down, it's a demand zone that's being respected. It's a totally different scenario. Or buying the dip over here, it's a totally different scenario. Even recently, buying these dips for those day trades, totally different scenario. So trying to buy the falling knife, that's why we always say, and we've been consistent on this, that's the dangerous play. It's
yes.
The key here is, can you be patient enough to allow those itchy fingers to get out? And I'm going to give another little tip here.
Yep.
If you have super itchy fingers and you have to buy, I just have to be in, man. I've got to be in. Okay. I've got the itchy fingers too, guys. Why not practice the idea of scaling into a position? So what that means is you might put in a quarter of your positional risk, or a third of your positional risk, or something smaller. It allows you in, and then it allows you to read the storyline. And once you do that, what you'll find is that you'll notice your initial entry is generally either really wrong and you get owned really quickly, which means you only lost a smaller amount of money, or it's still not going to be the best entry. Because what most traders don't think about, Ty, is if I buy this, where's my stop loss going to be?
Yeah, 100%. Look, that's
where the hell is it going to be?
Well, I probably at 5,000 if you want to be safe. No, all jokes aside, where is it going to be? It's 100% right. Where are you going to put it? You have to give it more room, right, than you would normally would. Why? Because there's nothing there to actually show you where it's going to go. So are you giving it too much room? Are you giving it not enough room? How do you know? I don't know. Do you know?
No.
That's the point. That's the point. Yeah. If you don't know, how can you trade safely there? Now, look, and I'm going to say this. Thomas and I didn't come out of our mum's wombs, being measured by a Fibonacci retracement, right? We weren't experts from the start. But I can tell you this. Catching the knife is a very easy way to start trading. We all do it at the start. No, there's no question. Yeah, go back to 2008 and 2009, and Tom and I would have been looking at these markets today saying, all right, Tom, I think we saw a stochastic change over on a minute chart. Let's go. This is the turn. Everybody does it at the start, and I do understand it. It's a mentality that people feel they need to apply to their trading. But if we could probably give you any advice that was really going to resonate with a market that's happening right now, it's don't do that. Because it's actually the hardest thing to do, catching a falling knife, and it's the one that's going to get you, cut up the most, your account cut up the most, because it is one of the most difficult things to do, because it truly, nobody actually knows. You are absolutely having a guess, and if you do happen to nail it, it's not because you're a market wizard. I can tell you that. It's because you've basically been lucky enough to do it at a time when the market did turn. It's not because you picked it, okay? Because these are impossible to pick. So the quicker you get that out of your, I guess, mindset, and wait for the opportunities to actually let price action tell you what's going to happen, let the market tell you what's going to happen, and then join in the flurry. Yeah, don't be the first one. Don't be the first one.
We're just back over here just to see these sectors. Again, the worst ones, we had some questions here, Ty, from people. The worst sectors of the day so far in the Australian market seem to be really around the metals and around some of those markets there. But if you click on this in the Tiger Brokers platform, you can see it comes up with the main stocks here as well that are in that sector. So some of them are in there. I don't know if everything's in there, but certainly this is a mixture of the banks and bank hybrids, it looks like, that are in there, which is interesting. And you can see some of these stocks, like look at these banks. The bank's down 5% here. So Commonwealth, NAB, Westpac, and ANZ all down around 5. What's interesting is seeing that Westpac's now gone under 20. And that's the first time for a while. But yeah, I mean, they're pretty large sell-offs. We're not going to say they're not. I mean, you look at ANZ, due to the government and the way that they're working on things here in the markets. This is a very big fall from grace in the recent days. And this just shows that the market has gone from, again, what we talked about before, which was just all about let's smash up all the growth companies, to actually everything else has to play catch up now. So the recent days here in these banks, these have pushed it back down, Tyron, to levels that we haven't seen in quite some time. So we're back into these August levels and November levels of 2020. All of the gain has been taken off now in just a few days. So yeah, dividend investing and stuff like that. It's because of raising the rates and, of course, what that pressure puts on in the housing market, which is the most important for the big four. So some pretty brutal sell-offs, but we're not going to try to predict the low here, are we?
No, not at all. Not at all.
Cool to be able to see it all here.
It's very cool to see it. Look, to answer Robbie's question there, he's got a question: is if the XJO does rally back, where will it go? Look, when markets are rallying back, Robbie, it's one of those things where we'll just jump back to the ASX if you can. What's going to happen, because it's broken extraordinarily key levels of support now, that is the first place you would expect it's going to rally back to. The problem is, of course, that support level is now going to be resistance on the first touch. So as much as it may rally up there, that's the target that you'd be basically aiming for, which is what we'd be expecting. That is going to be a target, but just be also mindful that's going to come with an added consequence now that support will become some form of resistance. Now, how strong that resistance is, time will tell pretty quickly. Like once it gets up there, you'll see the reaction, because realistically, is inflation going to go away, next week, next month, or even in 2022? Probably not. It could get better, but what good news are we going to see that would see this market back at 7,500? We don't really know that. That could make that, bad news can come out very, very quickly, and you can see a 700-point drop at the blink of an eye. It's very rare that you see a 700-point rise, especially at a time when, the market had concerns anyway. So any rally is going to be, every single place that you found support on the way down is going to give you resistance on the way up. But if you were looking for mini attempts at longing potential pullbacks, that would be the first place I'd be looking for, around that 70, the 68.50 to 7,000 is a very, very strong zone. Anywhere in there is where I'd probably fully expect it. And by then, if the 20 moving average catches up, like Tom's pointing out there, that would be quite amazing. And that would be not a place I'd be going long, if that makes sense.
Yeah, this would be an area where I think sellers would try to come back in. Of course, it would coincide potentially with some of the other markets around the world as well. These sell-offs are just, I know, because I've seen so many stats before on these, they're starting to get very lengthy away from some of these 20 moving averages. So I had a question before there, Ty, is now a good time to short? Under my opinion, no. No. We're hitting into a demand zone. We're not hitting into a short anymore. I think Tyrone was talking about shorting off these areas. And of course, that's so far worked off and been very, very good. But even then, you're descaling. The thing with being short in the markets and why these are hard to trade is you can't always bank on such incredible ferocity of these shorts. You have to be quick. And you have to be
exactly right. Yeah. So last week when I was talking about shorting from the 7,200, I didn't think it was going to 65.50. I was sort of thinking it's probably going to be, wasn't going to be surprised. I did say that I'd probably fully expect that we're going to see, a 68 to maybe 67.50 if it really sells off properly. These extra couple of hundred points that have sold off, no one could have predicted that. And I wouldn't even wanted to predict that. So yes, we don't foresee these crashes. For anyone who's wondering, Thomas and I don't see a 700 point. I wish we did. Boy, golly, but we don't. So I was I was sort of looking to the next support level, and did I take profits there? Absolutely, I did. Yeah, have I been in for the last 400 points? No way, of course not. Yeah, it would have been nice to. Yeah, and hindsight would tell you that maybe that would have been great. But this is not an event that happens every week. We're always happy with our targets, and that's what I'm saying. So that's sort of that 6,800 to 6,900 area should have been a really good support zone. So that's going to be a pretty reasonable resistance zone when it does eventually bounce back up there. So hopefully that answers your question.
All right. Well, look, Ty, let's go into the 1 minute charts here. I'd like to usually go through a whole bunch of different markets, but I know today is just such a brutal day for everybody. So next week I think not next week, and when we do this again in the future, if we're going to do an open, then we'll get into the sectors, we'll get into some rotation and all of those types of things. Problem is when the VIX is so high, it does make it difficult. If you're looking at a market like the ASX, you'll notice the futures market seemed to really gravitate to this 66. It's like a lot of sixes, 66, 70. So from a perspective of where the big resistance is that needs to be broken, it's sitting around this zone. Effectively, this, in the futures market anyway, holds orders. And this is what we call a supply zone. So now that we've made a new low, if we rally, pull up, come back down, probably hit something like around there, this would be one of those areas that traders are going to be looking at in terms of potentially opportunity. The key is to rally through this point, and then, of course, to see the pullback that allows us to pick it up. So just to reiterate that into something like the SP500 in the previous session, and if we take a look at this, in the previous session last night, Ty, we were talking about 38.20, 38.20, 38.20, 38.20. We know this zone held orders. We also know the market tried to rally twice into it and was both times met by supply shorting. So that's what caused that area. Is this an important zone in the future? I would say yes, it certainly is. 38.20 is super important because we know that there are orders that caused this sell and that sold again at this point. So to breach this, and to breach these three is going to be a big deal. And with making new lows, of course, it's going to make sense as well. So on the small time frames, this is where things change, just like the ASX 200 that we saw before. And that's what you've got to do. You've got to be patient. You've got to believe that not only will the market come back to these levels, but if it does breach these levels, you've got to be ready with a plan. What are you going to do after that?
Exactly right. And make no mistake, that's 6666 level. Thomas and I used to joke about it way back in sort of 2018, 2019, because we used to call it the devil's level, being all the sixes. And there was a period there in 2019 where on a monthly chart, it touched that 6666 level no less than 9 times on a monthly chart. So in a 9-month period, it did not deviate away from that level enough not to touch it at least once in that month. So it's a big deal. Don't worry about that. And your resistance, your short-term, very, very short-term time frame resistance for a scalping point of view is right on that number, the devil's number right there. So it's not just a number that's just formed now. This has been a number that's been very, very relevant for quite a few years. And so just bear that in mind, that it's not just a number that's formed in the last few hours. It's a number that's been there for a long time. Robbie asked the question, his investments of around 207,000.
Yeah. Can I answer Robbie's question just quickly, just with using this, which is going to be in today's video? I think it's the only way that we can really predict recessions. I mean, I've said this a few times. It's all about yield curves, and it's all about the US, If lots and lots of yields, that is all of these bond yields, start inverting, we're now at 20%, which is, by the way, a pretty high number. So 20% here, we're getting up there. That's like a reading from back in the early 2000s or late 2000s. That's like a 98 reading. If this goes to 50% plus, then Tyron and I will have to turn incredibly negative on markets over the medium to long term, like medium term. And what that means is the recession is coming. Now, we might say, well, Tom and Ty, the recession's already here. Hey, it could be. But we're not seeing one of our leads, which is this. So this is a yield curve inversions that tells us that we're in diabolical trouble. The bond market is rarely wrong. The bond market predicts early, and the bond market tends to be correct. Whether it was the pandemic or not, we were going to crash in 2020. Of that, I was almost positive. Well, I was pretty positive because, of course, the bond market told me so. So it's not our opinion. And Ty can take over if he wants to about talking about your investments there. But at this stage, I'm not overly negative in terms of not seeing a recovery in these markets at some point, whether it's right here or whether it's a little bit lower and we need to take all the fat off. It's not necessarily a bad thing that the markets are taking some of this steam out. If you have collectible markets and watches, Ty, you could go in, buy Daytona, sell for 400% list. You could sell a Patek for 600% list. That is, you buy it and you make 600% when you walk out and sell it on the gray market. I mean, that is ridiculous. It's never happened, actually, like that. So that just shows you the froth in the markets. And to take the hype out could be a good thing for your investments, actually, in the future.
Yeah, I think removing the hype is actually an important thing because it's the only way that we can actually move forward. Like, guess what? Now we're not going to all-time highs when we do eventually pick up and get going again. We've got predetermined and given levels where we can start aiming for. So the next time we get to 7,600, it's not going to be, oh my God, when's it going to turn? It's going to be, when's 8,000 coming? Because it's actually got there on a more, how can you say it? A better foundation. I think is probably the best way that you can describe it. Now, you know, like I said, none of this should be a surprise. And yeah, for all of you out there who have done the stock market masterclass, you know, and I know a lot of you have, you know, I would probably encourage you to go back and revise that because that basically has described, you know, word for word what has happened over the last 6 months, and you would not be surprised at all. In fact, if you just did it prior to this crash, there's no way you would have been longing anything. You'd have been quite happy to be sideways, but there's no way you would have been going long because it basically describes letter for letter what has happened in the economy for the last little bit. So, you know, you've got to be, this is not unexpected is probably what we're trying to say. This is just something that it's a nuance in the market that we work with. And I think that's probably the important thing. Work with it. Don't try and fight it. This is not the time to be doubling down, tripling down. And that when Tom says scale in, he's not talking about doubling and tripling down, right? So just so we're clear.
No,
tell them, Tom.
Scaling is a fractional portion of what you're willing to risk. If it's 1%, you're talking about a quarter. That means it's 0.25%. It doesn't mean, oh, let's put 1.25% of all our position on. It's about more scaling in and rewarding your trade, but you already have a fixed risk, whether that's 1%, 1.5%, 0.5%. It's just a portion of that.
Yeah. And I've said it over the last few weeks that, you know, because I've been asked a lot, you know, where do we think the market's going this year? And my opinion was that we were going to be somewhere between 66 to 6,700 to 7,400, probably in that range. And I did say several times that if we do that, that would be a good result. And that has not changed right now, by the way. Yeah, if we pick up off this level and this is as low as we go and we get back up, get to the high 6s or low 7s again before the end of 2022, I think that we've actually had a very successful year trading. That's my opinion, because I think that's probably that it's given us the what I don't want to probably see this year, and it might sound counterintuitive, is our market just exploding up to 7,800. And I don't think that's going to happen, by the way, but I probably wouldn't want to see that, because that would be a growth that is not actually a sustainable growth that you can invest with confidence. But a move from down here back into the mid 7s over a period of time is something that you can actually invest in strongly and believe in. And when that happens, then we're going 8,000 or 8.5, and then we're going to 5.5 on the SP 500. But then you're doing it with a very high degree of confidence in the market. I think that's the important part. This probably needed to happen to shake out that, you know, uncertainty, Tom. And I think we've been saying, this is not something we're saying now. We've been saying this for a while. So, and I know you guys, the avid followers, know this. So this is just the time that it's happened.
So I think there's so much going on, Ty. Look, you know, this is an updated one from Gary. Gary says, I was told most yields have inverted. This is taken from 13th in America. So it should be pretty accurate to 20-something%. This comes from Charles Schwab. So I'd say it's more accurate than probably some other people. Do they use all of the yields? The one thing that's unique about this circumstance, Ty, is that we haven't seen it's all yields. So that means the 3 months is also included. And of course, 3 months can't be inverting. Why? Because the 3 months so far, it's not even close to where the 10-year and the 2-year and the other 3-year, etc. all are. So to say all the yield curves are inverting, I don't believe so. I'm going to trust this stat coming out of a big bank rather than anything else. But I'm interested to see your data, and if you have something, let me know. He also says the bull run is over. We are closer to 3,500 than 5,000, so let's go to 3,500. Well, that argument is basically Gary's dooming the market, and look, he's not wrong.
Gary's gone all in, but I'm telling you, I'll tell you what, Gary, that the bull market has been over for a lot longer than this week. This bull market was over the first time the daily and the weekly made a lower high and lower low sequence on those indices, and that didn't happen this week. I can tell you that.
Well, you know that the case to be made for the 200 on the weekly is a big one as well. The 200 SMA, something that's been very, very, very big for a long time. So here we have, and I think Gary, the reason why Gary is going negative as well, Ty, is because he pulled a lot of stats for the community, which I thank him very much for. And actually maybe pull all the yield inversions for us, Gary, and get us a little bit of a daily update there. We'll love you very much for that one, if you can. So 29.32 on the Schiller still. Look, Ty, Schiller PE, while it hasn't seemed to have mattered for the last 2 decades, eventually comes back to roost. And we've seen times where it's gotten high, and those times, of course, knocking off in the markets. And that being time of, when was the last time Schiller PE became horrible? 1970s, really bad. Why? Because all of a sudden we had stagflation. So are we in some kind of stagflation as well? 29.32 is not cheap by these metrics. Ford PE is coming down to the right levels, but Schiller PE is not even close to where it was in the past. And this is based on an average. So if we go to S&P 500 PE, excuse me, 19. So average or mean and median here, 16 and 15. 19. Is it expensive? Not really. Is it super cheap? Not really. Is it actually the top of other previous markets in the past? Absolutely. And remember, again, 1970s, where did we end up going? All the way back down into this level. So I think there's a case to be said that the market is not a super rip-off anymore like it was. But at the same time, it's not really super bargain-based pricing. And I think that's where Gary gets something like a 3,500 or 3,400. When you start hitting those levels on the SPY, you're hitting a pretty damn good PE, aren't you, Ty? And this isn't short. This is just a 15, 16. That's where you want to be. A long-term investor looks at that, like a Warren Buffett, and he says, he's smelling value town, and he's getting out there. He's buying them up. He's buying the truck. But yeah, that being said, it's really about risk management into those points.
Yeah, most definitely. And I think understanding these, and look, I'd probably encourage people to watch a few more of these webinars that we do. Especially, this is an important one because this is one of the ones where you do get a lot of information that you normally wouldn't get about a market that's actually doing exactly what it's doing, because these are important things that help you actually understand and probably really emphasize what we're trying to say, and that is keep calm, don't panic, and trade with what the market's trying to tell you rather than what you believe, especially. But it's these points that give you the confidence that, maybe a market, Ty keeps saying that, the market's probably fair value is, somewhere in the high 6s to low 7s. What the hell's he talking about? It's these sorts of things that we're talking about, where a PE ratio can actually be understood and said, well, all right, I can actually live with that. When it's like anything, when you're buying something at the store and you're paying way, way, way more for it than you probably should, but you need it, so you feel you need it, so you're going to buy it anyway. You don't go away with a warm fuzzy feeling. Well, I certainly don't. And it's a little bit the same in the markets. If you're buying something at an absolute fair value, or what is considered fair value from many metrics that are compiled, you're going to be a lot more comfortable. Now, even if it drops in value, you're not going to be, absolutely terrified, because you've bought it at a reasonable level anyway. But and I'll give you an example. If I've gone and bought an apartment in Melbourne at the absolute market peak, when apartments, a ridiculous 2-bedroom apartment would cost you $1.5 million, right? Even though I've got a nice new apartment, I would be absolutely terrified that I've paid too much for this apartment, even though I had to have one because everyone else has got one, right? Now, if I've gone in and bought it at $1 million or 800,000, say, for instance, I would be a lot more comfortable with that, because even if it goes down to 600, I'm saying, I still, eventually we're going to be back at a fair value level. It is actually dollar for dollar worth that. But at $1.5 million, I've paid too much. And that's what high PEs are. Like you're basically buying something at the absolute, top. And I don't know about Tom, but I hate buying things at their top. hate it.
Yeah, I'm not a big fan. So that's why we've usually been much more hesitant to buy things early. But Ty, I think you bring up a good point, and that's something that people don't do in property markets either. They don't think about PE ratio. Like that PE ratio can easily be really worked out in some ways in housing. What's the average income? How many multiples of that income go into the average house cost? And if it's over or under a certain average, then you can kind of try to figure out whether it's super overpriced or not. And that comes to also the suburbs and also the other things. Data can actually lead you to making better decisions. And a lot of people are leading into that, into things like housing, but also into stocks. So I thought I'd bring up this weekly 200 type, because that comes in at the 350, which is obviously where we also have, I think, some left gaps here on the SPY. So there might be even a gap that sits around that zone. But 3,500, so this is 3,500. It's the weekly. And as we know, when markets get brutalized, this becomes a point where markets love to come back down to. And it's done this quite a few times. Once, twice, 3 times. I love the 200 very much for deep value. So that's where a lot of people, including a lot of bond managers, they're targeting the 350 and 320. And that's just their personal opinions. Obviously, I don't condone it. Neither does Tyrone. We don't know. But that's why I think they're coming up with these zones.
Yeah, and I think, and the point is too, are we going to be absolutely terrified if it gets there? No, it's going to be an opportunity. Look, Gary and I have talked about this. Gary and I are having an options party down at 3,500 with Gary. Like, we've talked about this many times, but and it is a reality if it does continue to weaken off. But again, I would prefer, if it is going to go down to 3,500, I know Tom would be the same. I would prefer that it actually meandered on down there in an orderly fashion, and then found the bottom down there. And that our friends here is the opportunity to say, okay, this market has found its base, and now we're starting to look good for some really, really good buying opportunities. Not a one candle wonder that gets to 3,500 in an instant. Yeah, we want to see that over a series of weeks, because not only does that give us an ability to actually trade it, but it also gives us an ability to understand how the market's forces are working at that level, and when they are consolidating properly at a level like that, and so it's not just pierced like a knife and continues on, or pierces back up, you have actually got a chance to participate. And I think that's what we all want, really. So if it is going to go to the 3,500, I certainly hope it gets there in a fashion that allows us to actually trade it. And then there is no reason to fear it.
I've got a question here about VWAP anchoring, and I think Ulrich, just send it to me a little bit later if you could, and I'll check it out. But basically, Ty, that's where we're at. We're at a point where the markets are hitting into extreme fear. We have the ASX 200. We kind of priced up some points there before, where we could see a little bit of a potential rally. By the way, weekly 200 sitting right on the price at the moment for the ASX. That is not for the US stock market. We've got that 7,000 kind of res that, if the bounce does occur, could come into quite a lot of shorting pressure. And of course, from the smaller time frame standpoint, we also have this devil number, the 66 millions of sixes. And that's a pretty heavy resistance. I can see it here. That's a supply. If we breach, pull back, there's real opportunity, I think, in some ways for building a system around that. But that's certainly a big one. Robbie says, Tom, you were checking ASX options. You still doing it? Yeah, of course, we always do options. But at the moment, the problem with the market today is that we don't really want to go into too much options stuff, because what's going to happen is it's really expensive. So unless you're selling credit,
the premium would be extreme.
Yeah.
Oh,
the
boy.
IB can be big. Yeah. So you've got to be careful. If you're selling premium, hey, these are the days to consider it if you know what you're doing. But if you're not selling premium and you're trying to buy options, geez, I tell you what, you can get wrecked. So I prefer to let the things calm down from that aspect. And as we do these shows over time, we will be looking at more sectors, more rotation, more individual stocks, all of those types of things.
Buying options today would be like walking through the desert with no water and finding a water stall and expecting to buy water at a reasonable rate. Not going to happen.
So Ty, I think that probably brings us to the end for today's session.
But if you're selling it, Tom, boy, oh
yeah.
boy.
Oh, well, that's right. I mean, look, selling premium. I remember selling an option with you, and it was like the 4,400 or 4,500 ASX, and you were pulling in like 16% for 3 months during the peak of that 2020 crash. Now, funnily enough, the market went up more than 16% over that time. But I tell you what, that premium was just a monster, and you were almost getting more for the 3 months than you were for the 12. It was really wild.
It was insane.
Yeah,
insane.
yeah, exactly. So. I guess from all of us here, we just want to say a big thank you to, of course, Tiger Brokers for sponsoring today's video. If you want to support the stream and support what we do here, then consider clicking the links down below. Obviously, they've got a couple of special offers, especially to Australian users. There's Australia, Singapore, US, and New Zealand, I believe, Ty, that all have a little bit of a promotion. But there's a special offer there for Australians in particular, as they're starting to enter into this market. And, I think that's unique to them, which is why I'm kind of looking at it. The app is pretty damn cool as well. So the app's got a lot of updates, which is nice to see. Robbie has one last question here for us, Ty. How long did it take you to get so much knowledge? 14 years. Tyrone, maybe longer. It took a while. Look, we try to teach and impart some of the knowledge we've learned over the years. But look, a lot of it's through trial and error. I mean, no one told me about special divs and options, Ty, and I'll tell that to everybody here. If there's a special div on a stock, the price, like when the dividend comes out, the actual special div component of the dividend will come off the strike. A lot of people didn't know that because it's not 100%. Written in most places. But look, it's a trial and error to a degree, and also, of course, trying to better yourself all the time. And I always think of it as this: if you have a bunch of inputs, if you're going to add new inputs, that is new information or data points, you may have to remove one of your already existing ones. And that's what Tyrone and I have done while we created the courses. And even when we create the scalping course, which we've already done, and we're in the process of obviously getting that ready over the next couple of weeks, check it out. It's going to be very good, I think. We take a certain level of inputs, and then, of course, we want to make sure that we don't add too many extras. And if we do add a new one, is it better than the others?
Yes.
So exactly why I like the 50% yield inversion is because that's better than a US 2-year, 10-year, and 3-month 10-year, which is what I used to use. I like 50% yield inversion, all of them yield inverting. Hey, that sounds better to me because it's actually more accurate. It's been so far statistically 100% accurate to pick recession since the 1970s. So far.
That's right. And I think, Robbie, probably the answer, to help answer your question, although it's taken us an amazing amount of time to gather up all this knowledge between us, what we have been able to do very successfully is actually, put that into the parts that we're talking about, the things that we know work well together. Now, let me assure you, if you've done the Ultimate Masterclass, the Options Trading Masterclass, Tom's mentoring, and the upcoming Scalping course, you know as much as we do. I can tell you that. And there's nothing that we don't do that is in one of those 4 things.
That's right. So I think people will really enjoy, the stuff that we've got moving forward. We held off a lot on doing the scalping because the scalping course is incredibly intensive. So what that means is it's not so much that it's super difficult, but you've got to remember that scalping is about understanding money flow. It's about understanding the orders, where the orders sit, when algorithms break those levels, what that then means, how you've got to position yourself into that position. Is it exciting? Yes. Does it give you an understanding of the markets like no one else? Yeah, of course. But you've also got to realize that it's all about liquidity, and it's all about understanding that you've got to do it on very liquid, very high volume positions, e.g. indices, metals, that kind of stuff, so that you can figure out why and how Wall Street effectively trap us, the retail traders. So it's going to be exciting, and I'm looking forward to doing it. But Tyrone, do you have anything else to say before we go?
No, I think we're about to wrap it up. I think we've been lucky enough over the last few years to build up an amazing community of people that we consider relatively well educated in the markets, and that's come from a lot of help from us. But a lot of people have brought knowledge to the market as well. So I think that we are far better placed now to actually bring that scalping, it's advanced scalping really, to the market, because now we've got an audience that can actually probably appreciate it far better than they would have 3 years ago. And I really mean that. I think we've got a far more educated group of people who follow us now, who are going to really appreciate it far more than had we done it a few years ago. So I think we've done it all in the right order. and that has been by design.
Tyron, I have to mention Bitcoin before we go out. Be careful of this market right now. There are liquidations going on across the board. There is a few companies now locking down people to actually withdraw their Bitcoins out. Staking platforms are obviously feeling the pinch. Where there's one, there's usually a few, unfortunately, because that's what happened in 2018. So it looks like crypto winter is unfortunately here. That can lead to some serious declines. And this is, of course, a very big representation of FOMO and fear and greed playing out. So the crypto market is frankly getting destroyed. It doesn't mean I've lost all faith in Bitcoin. I haven't personally, but I think that you've got to be prepared. Like, I was looking at this, and that's why we had that 32,000 as a level, because if that had broken, sure, we're in accumulation and we're breaking up. But until that happened, nothing was going on for me, and the defense zone got broken, and now we're in absolute disaster levels. And this is continuing to be an evolving story. So crypto market traders, be careful out there, guys. It's super brutal, and I feel bad for a lot of people that are unfortunately stuck in some of these coins. I mean, 21,000 from 60 whatever thousand it was, and Ethereum's down to 1173. So yeah, could we go all the way to 18 very soon? That certainly seems possible.
Nothing is off the cards in Bitcoin. In my opinion, nothing is off the cards.
Exactly. It could drop 50% in 24 hours from here. Due to the fact, if you lock down and you liquidated, anything is possible in this market right now. I'm telling you, like there is seriously weird stuff going on. And it reminds me of 18 again, when we saw some bust ups of companies and it turned out that they were moving cash into other things. And you just got to remember, a lot of these companies aren't necessarily in Australia regulated. Pick your brokers with care. That's the most important thing. You want to have regulation. Regulation is key. All right. Thanks so much, guys. Good luck today. And from both Tyron and myself, and of course, Tiger Brokers, who sponsored today's video, thank you so much. We'll see you next time, and I'll see you very soon on a video for the daily show on our main channel. Catch you for now. Bye.
Thanks, everyone. Bye.
Everyone's happy.